maintain the repo rate at 4%. Sorry for that. Now, we have heard Professor Benjamin Friedman from Harvard just a couple of months back when he was releasing his book. We specially requested him, given his expertise on the monetary policy and his work on the monetary policy and his research papers, numerous on the monetary policy, we wanted him to come and speak to us on monetary policy. Today is the day when we thought it would be most appropriate because the Reserve Bank of India would have announced its monetary policy in COVID. And we thought Professor will bring to us the highlights, given his vast experience of how monetary policy is practiced in the rest of the world. Professor Friedman actually needs no introduction, at least on our forum, because he has been here with us, and also because all of us are economists, and I think there's hardly any economist in the country, or in the world for that matter, who has not heard about the publications of Professor Friedman. So with this very small introduction, I'm sorry we are starting a little late. I hope Professor will be, it's 8 a.m. in Washington, in Boston, where the professor is speaking to us from. I hope he'll be able to spare a little more time as we have lost about 10 minutes in the beginning. Um, and then we'll have the question answers after the professor has spoken to us. So Professor, with this, I invite you to please enlighten us about the monetary policy. Professor.
Okay, well, thank you very much, Charan. Appreciate your inviting me. It's an honor to be here. I was very pleased to speak with people from the foundation a few weeks ago about my new book, and I'm glad to do it now on monetary policy. As I indicated before, because of the work that I've been doing on my new book, I have not been doing any new research on monetary policy, but I continue, of course, to follow the area closely. And so, as agreed, what I will do is provide an overview of my sense of where the profession is now in terms of the economics of monetary policy. I have some slides, and so let me see if I can share those with you. Let me see how to do this. Are you seeing some slides here?
Yes, we are. We can see them.
Good. Okay. All right. So you should be seeing a slide, a title slide. Is that what you're seeing?
Yes, thoughts on the economics of monetary policy.
Good. Okay. Excellent. All right. So here are the subjects that I plan to go through in the next half hour or so. And then I look forward to having a discussion. I want to talk about the monetary policy transmission mechanism, which is always a focus of research and has been for many years. I want to say something about the tools of monetary policy, which changed a great deal during the financial crisis of a dozen years ago, and I think are still evolving, especially here in the United States. We are continuing to evolve what we call the structural framework of monetary policy decision making. Then I want to take up two quite specific issues. One is the implications of persistently low equilibrium real interest rates, which for some purposes is a very good thing for the economy, but I think in the context of monetary policy creates certain challenges. And also the question of whether the Phillips curve is flat. In other words, the price setting mechanism is not responsive to the state of utilization of resources in the economy. And then finally, I'll conclude with a few comments on the current set of monetary policy decisions that we are now facing in real time in the US. So that's the agenda. Let me start with my observations about monetary policy transmission mechanism research. I would summarize the state of research in the following way. First, at the empirical level, what I find interesting is that not necessarily as a matter of research strategy, but more as a matter of findings. I think there is today less emphasis on the role of the traditional driver variables that we think of when we ask how central bank actions are transmitted to effects on real economic activity, namely interest rates and exchange rates, and correspondingly more emphasis on the role of asset prices and wealth. Now, this may itself be a reflection of the fact that we've been in a protracted period in which, in the wake of the financial crisis, in countries like mine, nominal short-term interest rates have been at or very close to the floor of zero, and therefore there simply hasn't been very much action in interest rates to look at. So any sample that's dominated by the last dozen years is not going to have a lot of interest rate movement there. Nonetheless, it's interesting that this is the way the empirical research is focused. And exchange rates, as you know, is that's a more complicated matter because it involves the relative movements in policy between two or more countries. Nonetheless, what I do find interesting is that in current quantitative empirical research, most of the emphasis seems to be on the role of asset prices, equities, for example, house prices, and also wealth effects. Now, at the theoretical level, the contrast that I see is in some ways a surprise to me. I see less analysis these days of the role of frictions and credit availability in the transmission of monetary policy. And I have to tell you that I find this surprising because if we go back a dozen years to the financial crisis and the sharp downturn in economic activity in many countries that followed it, much of the immediate reaction within the monetary economics community was to focus on financial frictions, as we chose to call them, and therefore on issues of credit availability. So I find surprising the fact that research in the field is now paying less attention to these kinds of frictions and issues of credit availability. And maybe other people in the discussion later will tell me that there's lots of research that I'm simply not aware of. But at least sitting here in the United States, that's my observation. Now, correspondingly, what I find interesting is that there is more analysis today of the implications of heterogeneity among different kinds of agents. And I find that very interesting. This is, in some sense, welcome to me. I am of a generation that grew up in the shadow of Jim Tobin many years ago. And certainly Tobin's work emphasized heterogeneity among agents. Some agents are credit constrained, other agents are not. Some agents have high marginal propensity to consume, others have low marginal propensity to consume. There are some agents have high risk aversion, others have low risk aversion. And so I've been very pleased to see that the current trend in research seems to be to take more account of these heterogeneities. Now, one thing that's continuing in the wake of the financial crisis of a dozen years ago is greater recognition of the growing importance of what we call shadow banks and even financial institutions that you wouldn't even call a shadow bank. Here is a chart that I took from a Federal Reserve Bank of New York publication some years ago, showing that in the years leading up to the last financial crisis, the shadow banking system, regardless of whether you choose to measure it gross or net, was growing much more rapidly than the conventional commercial banking system. This is in the United States. But then there was a reversal in the wake of the financial crisis. I was disappointed. I was trying to find, for purposes of this morning, an extension of this chart up through the present day, and I was surprised that I couldn't find it. Couldn't find one conveniently. It's easy enough to construct, but I didn't have enough time to do that. But I would be quite confident that if we extended this chart out another 10 years to get to the end of the 20 and teens, what you would find is a reversal in which the shadow banking system has once again expanded. So the old-fashioned um, analysis of the transmission of monetary policy focusing only on the banking system, I think, is a thing of the past, and that's probably a good thing. The final observation that I'll make is an expression of disappointment. While I'm pleased to see that research in the field is recognizing the growing importance of the shadow banking system, I've been disappointed, in all honesty, that research has not taken account of the growing importance, as I see it, of derivative financial instruments. In effect, we have diversified our research focus with respect to institutions, but not with respect to instruments. And I think that's unfortunate because in one market after another, the advent of particular kinds of instruments of a derivative nature, like credit default swaps, for example, I think fundamentally changes the way markets work and surely has an impact on the way in which central bank actions are transmitted to the non-financial economy. And so I'm hoping that over some period of time, research in the field will catch up with that. Let me now move on to the second issue on my agenda, which is these two tools of monetary policy that central banks around the world evolved during the last financial crisis. The need for doing so was pretty obvious. The interest rates were, short-term interest rates were down near the floor of effective floor of zero or a little below even in some countries, but we can't push short-term interest rates in a meaningful way much below zero. And so there were two new tools of monetary policy. The one that I think has the greatest promise is large-scale asset purchases, and I put in question mark sales because I'll come back to that in a moment. First, let's make sure we know analytically what we're talking about. Picture an equilibrium in the credit market in which the downward sloping red line is the supply of credit instruments. Think mortgages, for example. Think any kind of, again, this is the market for private credit, so think of that as corporate bonds, think of it as mortgages, think of it as risky bank loans. And the upward sloping blue line is the demand for credit market instruments on behalf of both the public and the central bank. Well, what happened in the last financial crisis, for example, is that there was a sharp shift to the left in the demand curve for credit instruments, leading to a new equilibrium at point B with a substantially higher interest rate than before, and also a substantially lower volume of credit being extended. And when the central bank then would respond, as central banks did, by buying their credit, by buying in credit, the demand from the central bank, in effect, is added to the demand by private sector investors. So that represents a horizontal shift of the demand curve back to the right, so that the new equilibrium following the central bank's asset purchase is at point C, in which they've succeeded in bringing the interest rate down from where it was at this post-shock equilibrium B, and they've also increased the volume of credit. And if we think of that action as being transmitted to the non-financial economy, here's a standard IS curve in which the initial equilibrium of aggregate demand was at point A, the shock moved it to B, and the central bank action improved the situation back to C. Now, two things to be said about these asset purchase programs. One is that there's substantial evidence of effectiveness. Not everybody agrees. I could name friends of mine in the American monetary policy line of work who disagree, but I think the overwhelming consensus and certainly my sense of the evidence is that these programs were effective. Here is just one survey of evidence. This was put together in the wake of the initial movement of central banks. This was done by John Williams, who is now at the head of the Federal Reserve Bank of New York. And if you just scan your eye down this far right column, you can see that while the estimates differ widely, nonetheless, there's a substantial agreement that there was some effect. And then I believe that this there are two implications of the success of large-scale asset purchases. One is that the central bank should continue on with the policy, and indeed they have. So here in the United States, for example, the Federal Reserve is still buying assets, long-term securities, as a way of trying to keep long-term interest rates low. And indeed, during the onset of the COVID crisis in March of 2020, the Federal Reserve expanded that purchase program to include a small amount, only a small amount of corporate bonds. Most of what they have is mortgages. I think there are also powerful implications for the optimal size of the central bank's balance sheet. And so let me say something about that quite explicitly. As I trust everybody knows, many central banks around the world have had enormous increases in the size of their balance sheets over the last 10 years or so. In the United States, we've gone from a balance sheet of the Federal Reserve under $1 trillion to today nearly $8 trillion. So we've multiplied by the factor of 8. There is substantial discussion, or at least used to be, of whether central banks should go back to a balance sheet that was more like what they had before the great financial crisis. And my answer to that is no. I think we've established a new tool of monetary policy, and it should be available to use in both directions. So, for example, when the economy was in the phase of buildup to the financial crisis here, and everybody understood that there were excesses in the residential mortgage market. And most people understood also that we were building new houses at a rate that was unsustainable and likely to create problems. There were several years in a row back in the mid-2000s when the United States was building new houses at the rate of over 2 million houses a year, compared to an equilibrium rate of household formation of maybe 1.5 million. People suggested raising interest rates as a way of stopping this. And to quote what Ben Bernanke said at the time, raising interest rates is a very blunt instrument to use to resist an excess in one particular sector or one particular market. But imagine that back in 2005, 2006, 2007, imagine that the Federal Reserve had had a portfolio of mortgage-backed securities that it could have sold into the market to widen out the spread between mortgages and treasuries. Well, that wouldn't have been a blunt instrument at all. That would have been a very good instrument. So my sense is that we should not go back to a balance sheet of the size of what we had before the crisis. Instead, we should retain on the central bank's balance sheet a large quantity of securities and think of those as available for sale when it's necessary to exert a contractionary pressure on the economy. And for this reason, 6 weeks ago, I was very distressed to see Jay Powell, whom I otherwise like very much, as chairman of the Federal Reserve, explicitly eschewing such a policy action. Back in mid-April, Jay said that he didn't think the Federal Reserve would ever actually sell securities into the market. I think that's precisely wrong. I think the balance sheet should remain large. I think the point of keeping the balance sheet large is precisely to have available for sale securities that can be sold and that they would sell if necessary to arrest the development of the economy. Moving on, the second new tool that emerged for monetary policy in the wake of the financial crisis was forward guidance. Let me quickly distinguish how I think of forward guidance as distinct from the way in which I thought of large-scale asset purchases. The story begins in the same way. Here again is a supply-demand equilibrium in the market for private credit. Think of it as mortgages or corporate bonds. Same shock as before, but now instead of a central bank purchase, which shifts the demand curve back to the right, we have a set of announcements by the central bank which changed the terms of the arbitrage between, say, long-term bonds and short-term bonds, or between risky bonds and risk-free bonds. And instead of shifting the demand curve back to the right, this is now a vertical shift in the demand curve. Now, as long as the lines are drawn as linearly, then now what is this? I'm getting a request to annotate the shared content. I have no idea what this is. So
We can see it very clearly, Professor.
okay,
The graph is very clear with us. We are not
okay,
getting any message.
yeah, I had no idea what that request is. So as long as the lines are linear, you could say it would be empirically impossible to distinguish a downward shift from a rightward shift in the credit demand curve, but that this is only a simple representation, and of course, in a richer empirical specification, it's very easy to do that. Now, analytically, it's all okay, but I think, well, now let's see. Now what's happening? Well, now I seem unable to, whatever that was, Sharon, it has interfered with my ability to uh,
Move to the next slide.
here we go. Now,
No.
yeah, okay. Now I'm doing it. Okay. So here we go. And again, here's the same transmission to the main economy. Well, analytically, that's fine, but I think there are two problems. One is that in contrast to the substantial evidence of effectiveness of large-scale asset purchases, my reading of the evidence is that there's very little evidence that forward guidance has been effective. And I think there's a further problem, and that further problem is that it creates a temptation for the central bank to make statements that are not genuinely revealing what the committee plans to do in the future. That would be fine in the interest of transparency, but instead in a kind of intentional deceit to um, try to uh, shape market expectations. And I think that's a recipe for a very bad road to follow, because ultimately that would lead to a loss of central bank credibility. So the conclusion I would offer is that yes, by all means, let's declare the asset purchase programs a success, and let's continue them and broaden them, but I'm very skeptical of a serious role for forward guidance. Moving on now to the conceptual framework of monetary policy decision making, both here in the United States and elsewhere, we're using a form of inflation targeting. I've written substantially about my reservations on inflation targeting. I'm not going to dwell on the subject at this moment. If anybody wants to ask me about it, I'm happy to discuss it. Let me simply say that I think what we're doing in the US in this regard is a lot better than what we were doing 10 years ago. What's new here is our uh, rethought framework for monetary policy decision making. And this was the result of a substantial effort that the Federal Reserve put in place several years ago under Jay Powell. Rich Clarida, one of my former students, who's now the vice chairman, was in charge of it. I'd say there are there's several aspects, but there are two that I take to be of principal importance. One is now that they are explicitly going to engage in time averaging of inflation targeting. And given that we have had a long series of years in which they undershot the inflation target, under the new framework, they are going to be not just tolerant of, but pleased by overshooting for at least some period of time. Now, the great ambiguity, of course, is that they did not say exactly what the time period was for the time averaging, but I think this is a significant development. The second element is that, again, in response to having undershot the target for so many years, they've been very explicit that this time around they are going to tighten policy not just in response to a forecast that inflation will go back to target, but only when they actually see it happening. Um, Whether that's a good idea or not, I'm not sure, because we all know monetary policy affects the economy only with a lag, and affects inflation with an even greater lag. But nonetheless, I think it's an understandable response to this experience of year after year missing the monetary target, always in the direction of undershooting. What's also interesting in the context, at least, of US monetary policy is the movement toward a broader interpretation of the central bank's mandate. And there's a whole variety of considerations that the Federal Reserve is now at least supposedly taking into account, some of which we've had several years to analyze, things like macro-prudential considerations, but some of which are very new. So, for example, the Federal Reserve has now been very explicit that they are going to take into account a climate or environment dimension to monetary policy decision making, principle through the vehicle of understanding the risk that climate change poses for the asset side of the portfolio of the banking system. Well, at one level, it's easy enough to talk about this in the abstract, but I have to say that translating that into concrete action by central banks is something that remains to be done. And then finally, back beginning with Janet Yellen, but now continuing under Jay Powell, there is a notion that the Federal Reserve ought to take account of social and racial inequalities and issues of mobility in our economy. Um, The usual, once again, so far they've been rather vague, but I think the idea is that even if the labor force as a whole, on average, is fully employed, if there are specific racial or other social groups that are facing high unemployment, maybe monetary policy should continue to be expansionary. Well, again, we're going to find out what all this means. Moving to the next item, as I'm sure everybody in this group knows, we have had a sustained period of extremely low equilibrium real interest rates. Um, I am not going to get into the question of whether this will continue. As I'm sure people are aware, many economists believe that this will continue. It's a difficult forecast to make because the truth is we don't know, I don't think, why equilibrium real interest rates are so low. So if you don't understand why a phenomenon has occurred, then you're not in a very good position to predict whether it will continue or not. But I'm going to contemplate potential questions of what happens if it does continue. The most obvious one is that there is therefore a greater frequency of any given central bank for any given inflation target finding itself stuck at the zero lower bound. Here in the United States, our interest rates have been effectively stuck at zero for 12 years now. Even if you go back to the liquidity trap chapter of Keynes's General Theory, I don't think he ever envisioned such a thing. The question that raises, and several people have raised it quite publicly, I think, for example, of Olivier Blanchard, question is whether this makes it worth raising the inflation target. I think so. I think that uh, if we believed that 2% was the right inflation target 12 years ago, we should not believe that now, because what we now know about the greater frequency of hitting the zero lower bound should surely make us aim for a higher inflation target, maybe 3%, maybe 4%. I've supervised several good theses on this recently. My political judgment, however, is that we will not do that, at least not in the United States. And say privately, I've talked to Jay Powell about that, and I just don't think there's for political reasons, I don't think there's a prospect of doing it. And then given that we won't, because I think we won't, there is a straightforward implication which is not very reassuring, and that is that because monetary policy will therefore be less capable of stabilizing the economy, there will be a greater need for stabilization from fiscal policy. And the question is whether that's politically feasible. And I will say right out that for the United States, I am highly skeptical. I think the current state of dysfunction in our legislative branch of our government is such that conceiving of fiscal policy stabilization in real time is really a stretch. So I think this is very unfortunate because it means that because of being stuck at the zero lower bound, increasingly monetary policy will not be able to do what we need done. And for political reasons, fiscal policy will not either. So I think this is not a happy prospect. Moving to the next item on my agenda, uh, I think the most fundamental conceptual challenge of all facing monetary policy is the question of what if it turns out that the Phillips curve, for any variety of reasons, is really flat these days. Now, I'm sure everybody, I've already referred to the failure. Well, to begin, going back even before the post-financial crisis period, um, most economists in the developed countries anyway, including me, were very surprised at how little inflation declined during the period immediately following the great financial crisis. There was substantial and widespread unused resources. And nonetheless, inflation really didn't move much. And since then, many of us have been surprised. I have been in what I've mentioned already, the inability of so many of these central banks to reach their inflation targets. In Europe, in Japan, in Britain, in the United States, we just keep undershooting the target. And as a result, empirically, evidence seems to point to a flatter Phillips curve. Here's a set of recent regressions, and as you can see, if you estimated the Phillips curve on a sample from 1960 to 83, you get this nice gray downward sloping line. If you estimate it on the sample of the next 15 years, you get this more heavily dashed line in which the curve flattened. And if you estimate the Phillips curve for the most recent uh, sample of 20 years, you get this heavy, solid black line. And as you can see, if you can see visually there is some downward slope of that line, but mighty slim. And so, for all practical purposes, the Phillips curve is flat these days. Now, I think this creates, if true, a very fundamental challenge for monetary policy, because if it's really true that inflation is not responsive to the state of utilization of the economy, then why is there any upper limit on the output target that the central bank should be seeking to achieve? Or to state it in terms of the labor market, why shouldn't the central bank be pushing the unemployment rate to zero? And who knows, maybe this is a logical way to think about the issue that I mentioned before, in which the Federal Reserve is now thinking about taking into account racial and other social issues in the US labor market. If we were having this conversation 15 years ago, and somebody from the Federal Reserve said that we want to push the unemployment rate down to the point at which the non-white unemployment rate is super low, uh, somebody would have said, well, that's bound to be inflationary. But what if it's not inflationary? Well, I think if if it really is true that the Phillips curve is flat, then almost everything that we think we know about the optimal design of monetary policy is gone. Having said that, however, I find it astonishing, and here I'm referring to the United States, how quickly the public conversation has turned from a debate over whether the Phillips curve is flat to concerns over potential reflation as the economy recovers rapidly from the COVID crisis, and especially if the Biden administration is successful in going forward with its infrastructure program. Now, finally, I'm aware that not everybody is interested in the United States, but I thought it would be just a glaring omission if I didn't say anything about the current state of U.S. monetary policy. So let me conclude quickly by referring to a few issues, and I'm, of course, glad to talk about it more. The first question, which is naturally on the table, is how soon the Federal Reserve should begin to raise short-term interest rates now that the economy is clearly recovering and recovering rapidly from the COVID crisis. And my answer is soon. I think much of the rhetoric of the Federal Reserve has become increasingly inappropriate and verges on forward guidance of the deceitful kind that I was referring to before. Uh, Monetary policy, to repeat, affects the economy with a lag, affects inflation even further with a lag. Unless we really do think that the Phillips curve is flat, I think they should get about soon moving away from super expansionary policy. The second issue that's on the table here is whether the interest rate that they are paying on excess reserves is going to be sufficient for the purpose of raising the federal funds rate, raising short-term interest rates now that our federal funds market has really withered. For all practical purposes, the federal funds market, which they always used to use, has become vestigial. To look at it in an analytic form, here's a picture of the federal funds market that would correspond to where we are today, in which the supply of reserves is so far to the right in the diagram that we're way out on the horizontal part of the reserve demand schedule. And therefore, in order to raise the federal funds rate up from 0 to some target, say we have a new target of here, it would be necessary to have a really massive withdrawal of reserves from the market. Well, nobody contemplates that because we now pay interest on excess reserves, and now, in effect, the central bank will use the reserve remuneration rate to set a floor under the short-term interest rates, on the idea that no bank is going to lend to a risky customer at an interest rate lower than that at which it can lend safely back to the Federal Reserve. So the question is this new mechanism going to be effective? And my answer is yes. I've looked at it, and many others have, in more detail than I, and I am not concerned about the Federal Reserve's ability to raise the interest rate. The final question that I pose for purposes of the United States is whether our higher and continually rising level of government debt will create a fiscal problem for monetary policy. In the technical language of monetary policy, this is called fiscal dominance. This is something we've never seen before in the United States, but I remember it many years ago in Europe when I used to go visit countries like Italy or Spain, for example. Italy's a good example. I would be visiting years ago at the Banca d'Italia, and we'd be talking about monetary policy, and I'd say, well, why don't you raise the interest rate by 1% or so? And they said, well, we can't really do that because the government debt to GDP ratio is about 100%. And so every 100 basis points that we raise the interest rate increases the debt service component of the government's deficit by 1% of GDP. And in the context of the history of government debt, this is the ratio of government debt to GDP in the United States, and you can see why, outside of World War II, when they did have to stabilize monetary policy, this was just never a consideration for us. Our debt ratio fluctuated between, say, 25 and 50%. Well, it's gone up sharply in recent years. The pandemic recession has raised it back up to 100. And under the pressure of demographic trends, it's going to be going up quite a bit in the next few decades. And if the Biden infrastructure program goes forward, and especially if Congress approves the program but doesn't approve the taxes to go with it, that will cause I should say should have said this chart is from the Congressional Budget Office. So when it says projected into the future, that's not Ben Friedman projecting, that's the Congressional Budget Office projecting under current law. But if the Biden program goes forward, the purple line would go up faster. So the question is whether we in the United States are now going to be in a period of fiscal dominance of that form. And my answer, fortunately, is it may happen, but it's not going to happen for a while. And so if we have this conversation again in 5 or 10 years, 15 years, Sharon, you can invite me back 15 years from now. Fortunately, you and I will still be here and we will do this conversation again. And maybe then my answer would be different, but for the moment, I think we're not there. So let me finish and thank you very much. And I'm now glad to go forward and answer any questions. And Sharon, I know we started late, and so I'm glad to continue on past the hour. I'm at your convenience.
Professor,
Let's
thank you very much. As always, a delight to listen to you.
let me
Maybe
see if I
when
can maybe you can tell me how to stop my screen share. I'm not seeing how to see if I can do that. No,
Vivek,
that
will you be able to help?
uh,
Somewhere it's here. Vivek,
well
can you help quickly? In the meantime, Professor, I would
well
like to say, as always, even at Harvard, when I used to hear you, mesmerizing, even today, the same thing. The topic was very wide, and the way you've given us all this in a nutshell in about an hour is really amazing. I have two questions, and I'm sure people and my friends in the audience will have many more. Um, Professor, the forward guidance thing, which even I used to fear, how are they going to do it? And then, of course, they said we're going to choose conditional forward guidance. And therefore, until the unemployment goes below this level or inflation goes above this level. Now, given the inflation scenario in the US and in advanced countries, that part of conditionality, of course, is gone. But maybe unemployment could be one threshold level. What would be your view on it? And the second issue, Professor, I've been thinking about it and writing about it, and I was very happy at the IMF in Washington. There's another author who also wrote about it. The background is the thoughts on demographics. Now, my thought has been for nearly a decade now, in a country like India, where we have very young demographics, very, very young demographics, 66% of our population is below the age of about 30 years. And then we have Japan in comparison, where the aging is there and the population is generally very aged. Now, comparing the inflation target and thinking of a uniform inflation target across the world, be it Japan and be it India, I thought was flawed. And I have been writing on this now and suggesting that demography should play a role in deciding what the inflation target should be. I've not been able to quantify it, and I'm not looking for colleagues with better knowledge of econometrics to do it. But I just thought I'll ask a question on this. And Professor, the last question I had in mind was related to debt, which you raised. Um, I thought, I know before the 2008 crisis, we all thought that debt management should be separated from the monetary management. But then I think Bank of England thought otherwise. And despite the fact that there were studies to show that bringing them together does not really lead to a cohesive financial sector policy, but Bank of England sort of reversed its earlier order of 1995 and said we would like to bring it together. And Professor, my thought was, and that's my question to you, would you think separating debt from monetary management would have helped in terms of the answer that these people gave you in Italy, saying that, look, if we raise our interest rate, our debt burden would go up. In a way, of course, as you know, that if we hold the interest rate at a rate where it is not market determined or where it is not the right thing, that's sort of the reverse side of the financial repression, which Ron McKinnon used to talk about. So just wanted to have your views on these three questions. In the meantime, I'm requesting the audience to please put your questions in the chat box so that I can see, or raise your hand and then I'll come back to you. I would like Professor Ravindra Dholakia. He's done lots of work on the Phillips curve. In our country, there's a leading journal, EPW, and Professor Dholakia published an article on the Phillips curve there, which we were discussing a lot. So I'm going to invite Professor Dholakia too to share his thoughts on the Phillips curve because Professor Friedman has talked about it at length. So, Professor Friedman, over to you for the three questions. In the meantime, I'll collect some questions from the participants and come back to you, Professor.
Okay, those are three very interesting questions, Sharon. First of all, I think what you are correctly pointing to in the trend in many central banks, certainly including here, to have conditional forward guidance, I think was a response to the frustration they were finding uh, at the feeling that their forward guidance was not being effective. And they were groping around for different ways of doing it. So, as you implicitly noted, here in the United States, we at first had unconditional forward guidance with no time limit. Then there were unconditional forward guidance with a time limit, then various forms of conditional forward guidance. Um, my observation is that uh, I just have not seen the evidence that any of this had much impact. And this is not a matter of high theory for me. It's a question of evidence. I used the table that John Williams made up to highlight that for the case of asset purchase programs, there's lots of evidence. And that's a table that John made up a half a dozen years ago. And in the wake of that, there have been, probably hundreds of studies showing, providing quantitative evidence of effectiveness of these asset purchase programs, and I just haven't seen it for the forward guidance. Now, I suppose the use of conditionality in the forward guidance might be a way of avoiding the deceitfulness that I'm concerned about and the undermining of central bank credibility. But again, we'll have to see the real issue. I mean, the central bank is not able to commit itself, and so, and nor should it. So the point is, suppose the central bank says that we're not going to raise interest rates until, I'm again using American numbers now, suppose we say the Federal Reserve is not going to raise interest rates until the unemployment rate gets below 4%. And suppose it's at 4.5%, and it's clear that we have a lot of inflation developing. Well, then what are they going to do? Are they going to consider themselves committed, and that it would erode their credibility to raise rates, and therefore they let the inflation just go unchecked until the unemployment rate gets below 4, if it ever does? I think these are difficult issues. So to repeat, I am very skeptical of the forward guidance. Now, your second question, I think, is a very profound one, and it has to do with, I mean, you framed it in terms of the choice of inflation target for a uh, primarily young country like India versus a primarily old country like Japan. The United States is in the middle, as you know, but closer to Japan than to India for sure. The question you are really posing is the one for which there's substantial theory, and that is one of monetary super neutrality. The issue is, to what extent can we segment the real features of the economy, uh, including not just the consumption investment balance, but even the age structure which lies behind the consumption investment balance. To what extent can we segment all of that real behavior from the nominal side, we would call that monetary neutrality, and from the growth rate of the nominal side, we would call that super neutrality. And as I'm sure you're aware, there's a widespread literature of conditions under which an economy exhibits either neutrality or super neutrality. My own instinct, and here again I refer to the work of Jim Tobin a half a century ago, my own instinct is that the conditions for super neutrality are not likely to be met in practice, and therefore it would not be surprising if the optimal inflation rate for an economy with one set of real specifications differs from the optimal inflation rate for an economy with a different set of real specifications. And surely high on that list of real specifications would be the consumption investment balance. And behind that, of course, lies, among other things, the age structure of the population. So now you mentioned 2% versus 5%. I am not aware of literature that would enable us quickly to come to a quantitative judgment. And so that would be a very interesting project. But I think at the qualitative level, and I'd be glad to talk with you about it, at the qualitative level, I think there is a well-established body of theory that enables us to think through these questions and come to qualitative judgments such that you could say, if that's the direction in which the difference goes, that the optimal inflation target for a young country like India is either greater than or less than the optimal inflation target for a country with a very different age structure like the United States. Now, finally, the third one of your questions again hits a subject that I've worked on substantially myself, and that has to do with the role of debt management policy. I have a whole set of papers arguing that debt management policy, namely the choice, by which I mean the choice of maturity of the outstanding government obligations, is an important tool of macroeconomic management. I continue to believe that. And for that reason, I've been pleased to see the uh, development of these asset management programs, because that's exactly what they are. They are a form of debt management. They are a way of reducing the quantity of long-term obligations that the public has to hold and increasing the supply of short-term obligations that the public has to hold, namely swapping bonds for reserves. So I think all this is a good idea. Your question was not about whether all this works, but whether it should be integrated with monetary policy decision making. And my answer is yes, of course. I think the existence and success of these these asset purchase programs in the wake of the financial crisis is an example of exactly that. Back in the 1960s, the United States had a very unfortunate episode in which the Federal Reserve tried to do a form of debt management policy. The code word for it was Operation Twist, in which the central bank sold from its own portfolio treasury bills, short term, and bought in long term securities. And the evidence was that it didn't have any effect. But the reason it didn't have any effect was that at the same time that the Federal Reserve was doing that, the Treasury was moving in the direction of issuing more long-term securities. So here you had the Treasury exactly undoing what the central bank was doing. Well, this is crazy. So my answer to your question is yes, for exactly the same set of reasons that I believe we know that debt management policy is effective, we should coordinate it with monetary policy. So yes, I would do that.
Thank you, Professor. Now, I'm very happy that Dr. Virmani has been able to join. But what I'm going to do right now is going to ask, there are quite a few hands which have been raised. We will go Just want to quickly check if Professor Ravindra Dholakia wants to make an observation, because I know that he has extensive work on Phillips curve, and that's why asking Professor Dholakia.
Yes,
Yeah,
yes, thank you, Charan. Uh, I'll be very brief. I have three observations. The first one is that, I had done some work way back in 1990. And at that point in time, my data set was before the economic policy reforms started in India. And that is where I found that the Phillips curve for India is practically flat. That means, aggregate supply curve was practically flat, as Professor Friedman was talking about. However, after the reforms, when I completed the exercise, and we did this exercise again in about 2015 or so, I found that basically there is a normal positively so sloped aggregate supply curve that we are getting for the country like India. Now that means that the concern about the flatness is not so much a concern for a country like India. It may be of late, it might be giving a different result. I have not updated my things up to that point. But anyway, what I am saying is that till very recently, the evidence suggests that there is an upward sloping aggregate supply curve. The second observation is regarding the optimal inflation that Professor Friedman was referring to. I think we have done a lot of work, and I had also presented a a talk in the same forum. And my finding has been that yes, certainly the optimal inflation rate, that is what we call threshold inflation rate, is different, substantially different for the developed countries versus the developing countries, where the structural changes occur very, very rapidly and extremely important for the growth. I think the threshold inflation for countries like India is going to be far more as compared to the countries like US or Japan or UK or Canada. I think these are the findings which are very, very clear, and it also suggests that yes, the threshold inflation for a country like India will be in the range of 5 to 5.5%, something of that sort. Now, the third observation, very quick observation, is that I am not very clear that how is it that if the interest rate on treasury is increased by 1%, it will lead to a 1% increase in 1% of the debt increase in the as compared to the GDP, because the interest rate on the debt is not on the margin, but interest rate on the debt is considered as a weighted average of the historical interest rates over which the debt is obtained. I think if this is the kind of things, that means that there is some kind of the space for increased interest rate without really impacting the debt servicing to the same extent. Thank you very much.
Yes,
Professor
well,
Friedman,
thank you.
Professor Friedman, before you answer, I just wanted to mention Professor Dholakia in our country is the former member of the Monetary Policy Committee of the Reserve Bank. And the threshold level study that he mentioned, he had presented at the foundation's webinar. I'll send you the link after the presentation. Yeah, and please go ahead, Professor Friedman.
Yes. Well, thanks very much for those observations. I found that very interesting, what you had to say. The first two don't require any response from me. I will respond to the third. And I very much agree with you. The longer is the duration or maturity of the outstanding government debt, then the less is the short run impact on the government's fiscal position of changes in the central bank interest rate. And that's why I picked a country like Italy for the example that back in the period before the euro, which is when this was all relevant, the Italian bond market was pretty much non-functional at longer maturities, and therefore the weighted average maturity of the Italian government's debt would have been very, very small. And therefore, you're right, it would not have been a direct pass-through of 100 basis points equals 1%, but it would have been closer to that than less. Here in the United States, I have argued for reasons that are like this, that we should be extending the mean maturity of our federal debt outstanding. It's something like 6 years the last time I looked, but I think we should aim for much greater than that, and we should be taking advantage of this current period of low equilibrium interest rates in order to lock in for the federal government low rates of interest. And it may be that these low equilibrium interest rates will be here indefinitely, in which case it wouldn't matter, but it may be not, in which case by the time we get to 6 years, 10 years, 12 years from now, we would be very glad to have done it.
We have a couple of hands raised. I would like to ask first Dr. Virmani, he's chairing the session, if he wants to make some observations. Otherwise, I'll go to the people who have raised their hand.
I will see the talk on the video tomorrow now. So please go ahead.
Okay. Okay. So there are a couple of hands which have been raised. I'll just go in the sequence in which they are on my screen. Anil Kumar would go first, ask his question. Then we have Anand, Mr. Anand. Anand Kumar goes second. Then we have Charanjit Singh, if he has a question. And then we have Pavitra Jena. And then we have Mr. Nagesh. So I would request to go in that sequence. So Mr. Anil, would you like to ask your question?
Thank you very much. Now that there is a quantitative easing for the last more than 12 years now, and there is fair amount of surplus liquidity in the system all across almost the entire world, but there is no sign of inflation or any other, the adverse consequences of high surplus liquidity in the system. The question is, was the traditional economic policy and thought wrong all along? Or is it too early for us to expect inflation and other related consequences?
Professor, I have a thought. Would you like to hear all the 5 questions and then go in the sequence of answering them?
No, I think it would be easier for me to answer each of the questions as they come up. So let's do that. Well, the issue that you're raising is, I think that's what I was regarding as the most fundamental one, namely, what if the Phillips curve is really flat? Now, as I indicated with the 3 regression lines that I showed, at least for the United States, and I believe for other developed economies, this evidence that the Phillips curve is flat is really somewhat recent. So I think it would be wrong to look back on, say, the period from the end of World War II up to 2000 and say monetary policy was fundamentally misguided during that era, because it proceeded on the basis that there was an inflation output trade-off when there really wasn't. I think there was a trade-off then. The question is whether there is one now, and we just don't know. I've been startled, surprised, astonished by the collapse of any evidence of a slope in the Phillips curve, but the data are as they are, and we shall find out. As I indicated also, though, I have been really surprised at how quickly, here in the United States at least, people are now worried about an increase in inflation. and not just cranks or not just uninformed people in the markets. There are substantial economists of reputation, including some of my own Harvard colleagues, who have expressed widespread concern about these issues, and we're going to find out. But maybe we'll learn a lot more. I mean, if it turns out that we continue to grow at this 6% plus rate for the next period of a year or two, and if it turns out that the resource utilization, including labor and other resources, continues to move up, unemployment moves down, and we do not have inflation from that, then I think this is going to lead to a very fundamental rethinking of policy. So your question is on the right track, but at least here we don't know yet.
Thank you.
Anand Kumar. Mr. Anand Kumar, are you there? Okay, maybe, okay. Charanjit, you want to ask a question? Charanjit? Pavitra Kumar Jana?
Yes, sir. Am I audible, sir?
Yes, you are.
Yeah. So, sir, my question is that considering this pandemic situation, central bank may become hostage of like due to because they're pumping more money, so that necessary adjustment become difficult. Don't you think, sir, that there is a serious obstacle of monetary policy tightening when inflation pressure comes and become flotsam in the economy? For example, India, it is now is 10%. So it will be very difficult for that monetary authority to manage. So this is the first questions. That then my second question is that regarding like developed countries, as you know that both macroeconomic forecast and various measure of inflationary expectation are based on like implicit or explicit on assumption of continuous past trend and economic behavior. They may not be able to capture the actual inflation risks coming out of economic out of due to the COVID-19 crisis. So there may be the case of anti-crisis monetary and fiscal policy response. So what are your views on that? Thank you, sir.
Sharon, my audio was not working very well there, so would you mind repeating those two questions for me, Sharon?
Sure, I can actually read them for you. I think his first question was basically on the implications on the fiscal policy, considering the increasing fiscal dominance that you talked about. Central banks may become hostages of fiscal authorities and the inability of governments to carry out a necessary fiscal adjustment on time. So he's asking, don't you think, Professor, this may create a serious obstacle to monetary policy tightening when inflation pressure comes, because flux in inflation pressure is still there? I think his second question is, again, give me half a second, I'm just reading from here. Both macroeconomic forecasts and various measures of inflationary expectations are based explicitly or implicitly on the assumption of the continuation of past trends and economic behavior. Therefore, they may not be able to capture the actual inflation risk coming from economic aspects of COVID crisis, the consequences of anti-crisis monetary and fiscal response, and longer-term demographic and structural changes faced by especially the developed economies. What are your views on this? So there are two questions.
Well, to take them in reverse order, first, it's certainly true that the economy is always changing and there are always new forces, and the COVID virus is a case of that. So it may well be that we are not able to forecast inflation. It could be that we're not able to forecast economic growth. It could be that we're not able to forecast all sorts of things, but nonetheless, we need to, we is both the economics profession and the central bank needs to carry on. And so I think recognizing the uncertainty associated with our forecasts is very essential. Trying to take account of new influences as much as we can is important, but simply disregarding forecasts is not a good way to go. I think that's it cannot be the case that our forecast is simply a flat distribution. Now, the first issue, if I understood, still didn't quite understand the question, but the first issue had to do with the question of fiscal dominance. And as I mentioned before, I do not see fiscal dominance being a serious issue for the United States in the next coming 2 years, 5 years, I would hope 10 years. I simply don't think we are there. I can picture it if we continue on our current trajectory of government debt compared to national income, then we could have a problem. But I just don't think we're there, and I don't think we're going to be there imminently.
Thank you, sir.
Professor Subramaniam, do you want to ask a question? And then we'll go to Mr. Nagesh. So
Thank you.
Professor,
Thank you, Dr. Charan Singh. And this is just one simple question. Thanks, Professor. Your talks have been very lucid and clarifying. My question is simple. Any prescription for India for combating sharply widening disparities in personal income, that is distributing justice? Do you have any special prescription from the monetary policy point of view? Thank you.
And again, my sharply widening disparities in what did you say?
Personal incomes.
Personal incomes. The question is basically pertaining to increasing income inequalities. Any monetary policy advice for a country like ours?
Well, here in the United States as well, I'm sure you're aware, we have had widening income inequality for really the last half century, and the subject is becoming more and more politically sensitive, and I think is a serious issue. It's now shaping policy in a whole variety of ways, and I'm pleased to see that here, at least, we are addressing it with ideas that are more fundamental than mere income redistribution. So to take one example, the Biden administration is proposing things like the universal availability of preschool education for all children. I think that's a great way to attack at the fundamental roots our widening inequality. Giving children who would be at risk of not taking advantage of education and therefore falling into the extreme left-hand tail of the income distribution, giving them more of an opportunity. Another element of the Biden program is to widen the availability of daycare so that women who currently are in the left-hand tail of the income distribution would be able to take jobs and move toward the center. So I think it's a widespread issue here. Now, I don't know enough about the sources and trends of income inequality in India. This is a subject that I used to talk about with Montek Alawelia quite a lot years ago, but I haven't done that for a while. But my instinct is that widening income inequality is a problem throughout the world. It's true in the advanced countries, it's true in the developing world, and I think we are clearly on an unsustainable path. And the question is, what is going to turn that around? And you could imagine all sorts of mechanisms, but I hope the mechanisms that turn it around are policy mechanisms rather than social ones. but I'll be very interested over time to see what happens in India, as I will be very interested to see what happens here. As you may know, among the developed countries, the United States has among the worst records of widening inequality over the past dozen, not just dozen, but the past 25 years. The last thing I'll say is that increasingly research and attention here is focusing not just on income inequality, but on wealth inequality. The two, of course, go together, but they are not the same. And some of the characteristics of wealth inequality differ from the characteristics of income inequality. And I think going forward, I would expect this attention paid to wealth inequality to become greater also.
Nagesh, would you have a,
Yes.
yeah.
Yes, sir. Good evening, sir. Sir, this is a small question. I want to know from your side, does this effort kind in US? And my bit worry, the last graph which you have shown, the public debt of US economy is the presently because of pandemic is almost 100% of the GDP, and it shoots to 200% within another 25 to 30 years, as the forecast says. If that is the case, does the US economy doesn't have this kind of a fiscal responsibility and budgetary management act? And can you give us we have seen in government in India since almost maybe 20 so 2000 this FRBM Act, which is functioning relatively, the states are in a position to control the debt. What's your stand
Nagesh,
on putting some
Nagesh,
targets?
yeah, we got your question.
Yes, sir.
I'll ask
Yes,
just because of paucity of time. And you know, the
yes, sir.
professor is at Harvard and we are engaging him. So just because of paucity of time. Professor, the question which Nagesh is asking is that in India, we have something called the Fiscal Responsibility and Budget Management Act, which prescribes what should be the deficit and what should be the debt limit. And in case they trespass that, the government has to specially explain as to why they're trespassing the limits there. So the question that Nagesh is asking, that in the projection of debt that you showed us, it seems that the debt will rise. Of course, it's more than 100%, but will rise above 200%. Is there something like that which in the USA would put a fiscal constraint on the runaway rise in debt? That's the question. Nagesh, am I right? That is the question. He has written it, and that's the essence that I got from it. Would you have any observations on that?
Yes, I would regard it as a serious problem if debt actually rose in pace with the CBO projection. The CBO projection is based on current law, and there are many things that we could change in the current law. The most important one of those has to do with the medical system. The rise in debt that's projected over those next 3 decades from the current time out to the middle of the 21st century is almost exclusively an artifact of the aging of the population. And then within the category of fiscal consequences of aging of the population, it is mostly an artifact of the way our medical system works. So if you break it down crudely into the income support system, which is what we call Social Security, and the medical care system, which is what we call Medicare, that's the government paid medical care for the retired elderly, people who are, or even not retired elderly, people who are 65 and over. The overwhelming majority of the fiscal problem comes from the medical side, not from the income support side. So I think, and this is the subject of a whole other conversation, but at least here, the great challenge on the fiscal front is to reform the American medical care system, and in particular to reform the part that is paid by the government on behalf of the retired elderly. I think that's where that enormous growth in fiscal obligation comes from. Now, we may be successful in making those reforms, and we may not, because clearly these are issues of enormous political sensitivity and social responsibility as well. So we may or may not be able to make those needed reforms, but I think if we are not, then I think everything that you said follows, that we then have a period of fiscal unsustainability, fiscal dominance, and then we are in a very bad position. But I would not dismiss out of hand the possibility of making progress through reforms. And here I'm not talking in the abstract about reform of everything and everybody. I am talking quite specifically about reform of the medical system.
Professor, we'll take the last question. I know we are taking too much of your time. I had promised 1 hour and this is already 95 minutes. This is the last question. Charanjit, do you want to ask it yourself or you want me to read from the screen? Let me read it. Charanjit Singh is asking a question. In the absence of true central bank's independence, does it really make any sense to separate debt management function from monetary management function?
Well, my answer is no. I think regardless of the level of central bank independence, as I was indicating before, these functions ought to be coordinated for the reasons I gave. And here in the United States, I think we have a we are pretty far over on the spectrum of central bank independence. But even with our level of central bank independence, these functions ought to be coordinated. And I think in a country where the central bank independence is significantly less than ours, then the answer would be the same, if not more so. These really are it's not that monetary policy is identical to debt management. I think it is that monetary policy includes measures like asset purchase programs, which are very much encompassing debt management, and therefore it makes sense to do them together. So it doesn't make any difference to me exactly where this function is located, except that my bias coming from the United States is that the Federal Reserve is always much more competent than any other government agency I know. And therefore, given the choice of whether to put some function in the central bank or elsewhere, my bias is always put it in the central bank, because then there's a greater chance that it will be done correctly.
Yes, Professor, I agree with you. I totally agree where the function is, but the need is to coordinate as much as possible. Once again, I go back to our chairman, Dr. Virmani, if he wants to make any concluding observations before we conclude the session.
Hey, Ben, I'm sorry. We had a big storm here and I couldn't figure out. I guess I'm getting old. I finally figured out that there were 3 choices and I kept going between 1 and 2. I never got to the third one. Anyway, so sorry I missed it, but I'm going to watch it on the YouTube tomorrow when it's up. So, but thanks a lot. And again, as Charan said last time, I hope we'll have you on some of your other books also at your convenience. So thanks for.
Okay, thank you.
Okay, Charan.
Thank you, Charan. It's been a pleasure to be with you as always.
Thank you.
With
so
luck,
much.
I'll get to come visit you in person.
Said, absolutely, once the lockdown is over. I just want to make 2-3 announcements. First of all, as we have had this is from Professor Friedman. I would like to thank him profusely for spending time with us. As he mentioned at the outset, he's been busy with his new book, but because we requested him to deliver a talk on monetary policy, as you noticed, he's put so many things together for us. So we really thank you. I also thank the participants for such a rich participation, asking questions. We will be putting up the recording of today's presentation by tomorrow noon. You're welcome to see it. In the programs that we have for the next 1 week, we have a very rich week actually. This one, I think the most rich week. On June 10, we have Professor Shankar and Rahul Dey speaking to us on artificial intelligence and machine learning. June 10, both the professors are from IIM Bangalore and they run international classes on the subject. On June 11, the Friday, we have Shweta Saxena from United Nations ASCAP speaking to us about the regional economy. It's a 90-minute session. On June 12th, we have Dr. Anthony speaking to us about the health issues in India. And on June 14th, we have Professors Bala and Professor Sinha speaking to us on MSME in the COVID scenario. Of course, on June 18, the Friday after that, we have Manjeet Puri speaking to us on Nepal. So the next week is going to be a really very enriching week, and I'm requesting each one of you who's present to please the same time, 5:30 to 6:30, maybe 7, we'll be doing this. Once again, thanks to all of you, and once again, thanks to Professor Friedman for sparing time and permitting us the extension that we have had so far. Thanks to our chairman, despite the storm, and despite that he couldn't hear Professor, he joined us to look at the participation and get the best of it live. Thank you very much, all of you. Thank you. Thank you, Professor.
Thank you
So
very much,
kind
sir.
of you.
Thank you.